Welcome to our channel, Stock Market Analyst. Today, we're diving into the basics of how inflation impacts stock market performance. By the end of this video, you'll have a clear understanding of what inflation is, how it affects the stock market, and how you can use this knowledge to make informed investment decisions. Don't forget to like, subscribe, and hit the bell icon for more investing tips. What is inflation? Let's start with the basics. Inflation is the rate at which the general level of prices for goods and services rises, leading to a decrease in purchasing power. In simple terms, when inflation is high, your money doesn't go as far as it used to because prices are higher. How is inflation measured? Inflation is typically measured using the Consumer Price Index, CPI, and the Producer Price Index, PPI. The CPI measures the average change in prices paid by consumers for a basket of goods and services, while the PPI measures the average change in prices received by producers for their goods and services. These indices provide insights into the overall price trends in the economy. How does inflation affect the economy? Inflation has a significant impact on the economy. Moderate inflation is generally considered a sign of a healthy economy, as it indicates growing demand for goods and services. However, high inflation can erode purchasing power, reduce consumer spending, and create uncertainty for businesses. On the other hand, deflation, or falling prices, can lead to reduced economic activity and increased unemployment. How does inflation impact the stock market? Inflation can have both positive and negative effects on the stock market. Here's how. 1. Earnings and profits. High inflation can increase the costs of raw materials, labor, and other inputs for companies. This can reduce profit margins and earnings, leading to lower stock prices. Conversely, moderate inflation can boost company revenues if they can pass on higher costs to consumers. 2. Interest rates. Central banks often raise interest rates to combat high inflation. Higher interest rates increase borrowing costs for companies and consumers, which can reduce spending and investment. This can lead to lower stock prices. Conversely, lower interest rates can stimulate spending and investment, boosting stock prices. 3. Investor sentiment. Inflation can create uncertainty and volatility in the stock market. Investors may become more cautious and reduce their exposure to stocks, leading to lower stock prices. Conversely, if inflation is under control, investor confidence may increase, leading to higher stock prices. 4. Sector performance. Inflation can impact different sectors of the economy in various ways. For example, consumer staples and utilities may perform well during periods of high inflation because they provide essential goods and services. Conversely, sectors like technology and consumer discretionary may be more negatively affected by rising costs and reduced consumer spending. Practical example. Let's look at a practical example. Suppose inflation is rising, and the central bank decides to increase interest rates to combat it. Higher interest rates make borrowing more expensive for companies, reducing their ability to invest in growth and expansion. This can lead to lower earnings and stock prices. Additionally, consumers may cut back on spending due to higher borrowing costs, further impacting company revenues and stock prices. On the other hand, if inflation is moderate and under control, companies may be able to pass on higher costs to consumers, maintaining their profit margins and supporting higher stock prices. How to use inflation information for investment decisions. Understanding how inflation impacts the stock market can help you make better investment decisions. Here's a step-by-step guide. 1. Monitor inflation data. Keep an eye on inflation data, such as the Consumer Price Index, CPI, and Producer Price Index, PPI. These indicators provide insights into price trends and inflationary pressures in the economy. 2. Analyze central bank policies. Pay attention to central bank policies and interest rate decisions. Central banks often adjust interest rates to control inflation, which can impact the stock market. 3. Evaluate company financials. Consider how inflation might impact a company's costs, revenues, and profit margins. Companies with strong pricing power and the ability to pass on higher costs to consumers may fare better during periods of high inflation. 4. Diversify your portfolio. Diversify your investments across different sectors and asset classes to manage risk. Some sectors, such as consumer staples and utilities, may perform better during periods of high inflation. 5. Stay informed. Keep up with market news and trends to make informed decisions. Understanding the relationship between inflation and the stock market can help you anticipate potential market movements. Common mistakes to avoid. While understanding inflation is crucial, there are some common mistakes to avoid. 1. Overreacting to short-term changes. Avoid making impulsive decisions based on short-term inflation data. Focus on long-term trends in the overall economic context. 2. Ignoring other factors. Inflation is just one factor that impacts the stock market. Consider other factors, such as company fundamentals, industry trends, and geopolitical events, in your analysis. 3. Failing to diversify. Don't put all your eggs in one basket. Diversify your portfolio to manage risk and take advantage of different market conditions. 4. Neglecting risk management. Always have a risk management strategy in place. Use tools like stop-loss orders to protect your investments from significant declines. To sum up, inflation has a significant impact on the stock market. High inflation can increase costs for companies, reduce profit margins, and lead to higher interest rates, which can negatively impact stock prices. Conversely, moderate inflation can boost company revenues and support higher stock prices. By understanding the relationship between inflation and the stock market, you can make more informed investment decisions and manage risk effectively. That's a wrap on our guide to the impact of inflation on stock market performance. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Have any questions or topics you'd like us to cover? Drop them in the comments below. Happy investing!